Hello, I'm Chris Sarley, Investment Research Analyst at Chelsea Financial Services, and today I'm delighted to be joined by Cormac Weldon, Manager of the elite-rated Artemis US Smaller Companies Fund. Thanks for joining us today, Cormac.
Not at all, thank you.
Let's start with some big picture if we can. US smaller companies have performed better than the S&P 500, the larger index, over the past year, and in particular since the end of October. Could you maybe talk us through why that's the case?
Sure. Smaller companies tend to do well during an economic recovery. Obviously, we had a sharp recession 18 months ago, and really since then, the economy has been recovering. We've seen the economy start to pick up again. We've seen consumer demand start to pick up. Companies are confident. They're starting to hire people. So in the context of an improving economy, and one that's thought to be able to grow quite strongly, smaller companies tend to do better. They're smaller local companies. A lot of them are closely tied to the prospects of the economy, like trucking companies as an example, banks as well. Obviously, demand for consumer credit increases, and as we go into the recovery. So it's really that connection with the economy and the recovery of the economy that's good for smaller companies. The impact of all of that is that their earnings growth has been very strong. So it's based on the strong fundamentals of those companies, which is provided by the strong economy.
You mentioned the strong economy. Obviously, the US stock market has generally seemed to be hitting new all-time highs for months now. Can that sort of strength continue, or are you cautious about 2022?
Well, I think 2022 is going to be, in some ways, a little bit more complicated. Now, in one very important way, hopefully it's more straightforward. One would hope that 2022 will be essentially a good environment. Let's see about that. However, in another way, it will be a little bit more complicated, and that's because we do expect the Federal Reserve to start tightening interest rates at some point next year. At the moment, our best guess, and the Fed's best guess of that, is that will happen from the middle of next year. We would expect that to be very gradual, but nonetheless, there's always some concern when the Federal Reserve starts tightening interest rates, because really what they're trying to do is slow down the economic growth and inflation a little bit. And that can cause complications in the market. Now, we are reassured, though, that the Federal Reserve have been clear that they will do this very gradually. And the fact that they've been very clear about when they expect to start, and the fact that it will be gradual, means there shouldn't be any real surprises for investors. So while it might cause some volatility, we don't think it'll be fatal for the market. We don't think it will result in significant drawback. The other aspect of it, the economy to still be growing and earnings growth to be still coming through.
You mentioned the interest rate rise there. Could you maybe go into a bit more about how you think that would affect small caps in particular in the US?
Yeah, I mean, really, it's the flip side of my answer to your first question of if the economy is doing better and perceived that it will continue to do better, we would expect smaller companies to do well. Now, if the market perceives that the Fed is making a mistake, for instance, by raising interest rates, that they're going to slow down the economy too much, then that could be negative for smaller companies, certainly more negative than for larger companies. As I said, though, we do think that the Fed has been very clear about their intentions. However, I do have to say that the prospects for inflation are incredibly important. At the moment, inflation is running high for a number of reasons, we believe, some of which we think will recede next year. Essentially, the supply chain issues that we're seeing not only in the US, but also in the UK mean that prices have gone up. We would expect those prices to come down next year when goods are more readily available. But the prospect for inflation is important. So it's something we will be looking at closely, because that will help us form an opinion as to how quickly interest rates tighten.
Let's turn to the portfolio. We've obviously got an interesting mix of companies in there. Could we start firstly with Axon Enterprise, a company that makes weapons? Now, obviously, responsible investing and avoiding companies that do bad things has been in the spotlight more so than ever recently. So is that sort of a holding that worries you? And are you worried that people will perhaps put off by the fund if you invest in a company like that? Could you maybe explain that to us, please?
Sure. First, let me explain how we incorporate environmental, social, and governance aspects into our research. And that is to do it from the very start of when we're researching a company. So we're not just looking at the financial aspects of a company, but at those ESG issues. And Axon is definitely an interesting example. I will grant you that. And what Axon do is they do two main things. First of all, they are the manufacturer of tasers, and also they do body cameras for security guards and police forces. So while some classify those as weapons or the tasers as weapons, they clearly, in the context of the US, where there's armed police forces, they present a solution that is more favorable than the alternative, which would be to carry a firearm. So in the context of the US and the business they operate in, actually we are quite reassured by what they're doing. And so, for instance, we know civil rights groups are very positive towards their body cameras, as that helps record any engagement between the police forces and the public, and obviously is somewhat helpful where there is debate about what may or may not have happened. And the other aspect of it is that the company have rated very highly from a governance point of view. And that is very important because they are operating in a sensitive part of the economy. And so it's very important that they have a strong independent board of directors, for instance, who can interact with the management and make sure that the management is behaving in the most ethical way.
Let's talk about another one. So obviously truck drivers have been in the news a lot here in the UK, or well, should I say the lack of them, basically. You also own two freight truck companies, TfL International and Sire. Is this a play on the demand for more haulage?
And partly, although that's not the most important part of it. Essentially, Sire and TFI are two businesses that have invested a lot of money in building a network, which they are now going about making the most of. So they are so-called less than truckload operators. They take small items from businesses and then aggregate them into one load and ship them to their destination. The key part of it, so the key part of the stories of the investment case is actually what they're doing internally to become stronger businesses, to be able to raise pricing and improve profitability. I do have to say, though, that the question is correct. Having a good economy is certainly helpful to enable them to achieve their goals. I should just say, relative to those companies, in the US, there's also a shortage of truckers. But within the trucking fraternity, the jobs that are offered by Sire and TFI are amongst the best jobs you can get. Essentially, the people who drive these trucks get to spend their night at home. They're not driving across the country and being away from home for weeks on end. And that's certainly, it's that part of the industry which has suffered from a reduction in the supply of truckers.
Thank you for joining us today, Cormac.
Not at all. Thank you.
And if you'd like to learn more about the Artemis US Smaller Companies Fund, please visit chelseafs.co.uk.